Good day, John here with another update, and today we're really going to try to accomplish more on our learning curve. So the more you learn, the better served you'll be. And the more this last few weeks I've had much more time off, and I spent time watching news programs, hearing what the experts are saying. And I will tell you, some experts I've learned a lot from, and some of them I think, my gosh, I hope my clients are not listening to them. So we're going to kind of take that apart. What I haven't really talked about was the market. My emphasis is always what we're going to do, but I want to address the market a bit. This is not like any market any of us have ever seen. This market is much worse than 2008. Many people are saying this is bad or worse than the Great Depression. Well, how can that possibly be? Well, think about it. The Great Depression occurred with a banking crisis. 2008 was a mortgage banking crisis. This was something outside the market, though, something we really weren't looking at, and it affected the market across the board. So sometimes when you're looking for a solution, if you're not looking bright-eyed, wide-eyed, you're going to miss the possible answer to the problems we have. I'll give you an example. I look at portfolios today, come to my office, people are looking for help, and I see them invested the same way they were last year. Let's just look at that. Think about it. Think about bonds. What do we know about bonds? Kind of a safe place to be, right? You think so? What is a bond? When you buy a bond, you're loaning somebody money, aren't you? Well, what do you need them to do? You need them to pay you back. There's going to be 100,000 restaurants across the country that will not open again. This is going to hurt Fortune 500 companies. This is going to be a huge, huge problem. And the bond agencies bonds have been rated down significantly. So corporate bonds, I think that's a really risky bet to be, and that's why we're not there. I'm not saying they didn't used to make money. Again, you're loaning somebody money. We have to depend on them to give us our money back. In a moment, I'm going to show you what we're doing and why we're doing that. Yeah. Now, I want y'all to use your own brains. I want you to think about this. I'm going to share with you something I watched this week that just made me lose my hair. A gentleman came on one of the major news networks talking about the terrible, terrible crash that's going to occur in the market going forward, how bad it's going to be. And so the interviewer said, well, sir, if it's going to be so bad, wouldn't people be smart to get out of the market? And the analyst waited for a moment. Yeah, he would. However, if they've got gains in their stocks, it's going to cost them to sell out of those stocks. So they shouldn't sell out of them. They should just keep in the market. And then not only that, they should buy more. Do you hear what just happened? In one instance, get out is a bad place to be. The other is don't get out because it costs you some money in taxes to get out. And now, rather than sit still, go buy more risk. I really hope you understand how just the inane comment that is. It doesn't make a lick of sense. It's kind of saying, you know what, I'll lose $1 to save 15 cents. So that's the tax equation there. So let me show you what we're looking at right now that's real important. I want to show you how this market compares to 08. So let's take a peek. All right, so the faded red line was the 2008 marketplace, and we had this precipitous drop here with the collapse of Lehman Brothers, way down like this, something we really hadn't seen before. And then here this year with the coronavirus, we had a steeper drop than ever before. And these markets, if you notice, they don't go straight down. They go down and up, down and up. And so right now we have a good little bump from a real tough fall. So as our clients, we're already out of the market. We're not in, we're going to address in a moment what we're in. But I would warn anybody that's not following this advice to be real careful, because this can give you a false sense of security when the market rises up. This market is going to go down, and I think down a whole lot more. Just drive down the street at nighttime and look at the infrequency of cars passing you up, and that's across the globe. So as we look at this, the strategies we're using right now are going to benefit from more of this. So you see these strong drops. The strategies we're using will actually benefit from this. However, keep in mind, stock strategies will not do this. So let me take a moment and show you what we're going to do, or what we're already doing, that's going to take something that's very bad for most people and put us in a very good position. Okay, now I want to talk about what we just looked at. We saw where the 08 market went down horribly bad, and we're keeping pace with it as of right now. And I will tell you, for the first time on a video like this, I think the market is going to be potentially as bad or worse than the Great Depression. However, we're not in the same boat, gang. Google how many people became very wealthy during the Great Depression. I will tell you what won't work, though. These times, what normally works will not work. So we can have a bull market, that has a correction of 10%, we're going to stay fully invested. We're going to buy and hold during a correction. We are not going to do that in a recession. We will lose our shirts. You can't expect the same thing to occur. So Alex and I were prepared for this. I want to show you what we're invested in. And also, you're going to find that we're invested in the only things that are moving right now. And if the market gets much worse, how do you think they'll do? Let me show you real quick here. Take a peek. So what we're looking at here is a chart that shows various asset classes and how they've done year to date as of March 18th. You'll see that oil is way, way, way down. You'll see that emerging market stocks are way, way down. Why in the world you'd have an emerging market stock in this environment? I cannot possibly find an argument for that. Commodities are a tough spot. The S&P 500 down. All the market, all that we're told always to diversify in. If you diversify the market, well, where are you? The gains are to the right of this. So what happens if you're fully diversified here? Well, I'll tell you what's going to happen. It's going to get a whole lot worse. And so if we want something different, we must do something different. Take a look at gold up here. This is as of the 18th. I think we're a little positive in gold since we bought it. But what would happen if we have a further breaking down of our financial systems? Gold goes up. In 2008, the US dollar went up, I believe, 25%. And what about these old boring treasuries we're buying? I heard somebody the other day on the TV show say that, well, you shouldn't buy treasuries. There's no yield. We're not buying them for the yield. Around the globe, if countries or corporations want to park their money in a safe spot, what's the safest spot on planet Earth to park your money? The U.S. government. And these are sold at treasury auction. So the more people buy them, the higher they go up. So if things get worse for us, as I fully expect them to, and I don't think any analyst is going to tell you it's not, we will benefit from this. Having said that, we're not going to stay here. As the market recovers, we're going to be in those assets that are moving forward. Okay, now I don't want you to misinterpret this. I've kind of told you the down and dirty on what I think the market's going to do, but I also told you I think what we're going to do. We can't control this market, but we can certainly use our heads and do a whole lot better on it, and we've done pretty doggone well since we reallocated our portfolios here just a few weeks back. Now, having said that, you are going to know people that get hurt immeasurably bad from this market. Hopefully they're not family, but they might be families or friends. And if they're doing what they've always been doing, that's the first clue they're going the wrong direction. We've had so many people share their friends and family with us last month. And I welcome you to pass their name on to me. I can visit with them on the computer to give them some advice. I think there's really not a better time for what I do. This is why I'm in business. So I really want to hear your feedback. By the way, I only had 2 people contact me last week with a comment. They were both happy with how we're doing the job for them. So that was very, very good. If you are concerned, do absolutely give me a call. I want to hear about it. And we'll be talking to y'all again real soon. Take care.